topic for the day is technology, and our conference is very much focused this year on that very aspect, because technology is part of every single part of our lives, both on a personal and a business level, and it's gaining ground in areas like investments, obviously being one of those areas as well. And Zyron is going to give us a bit of background on how AI and algorithms fit into the investment fraternity. Zyron, good morning.
Good morning, Chris, and thank you for having us at your wonderful conference. As you correctly mentioned, AI is at the center of almost all applications used today across industries. Like you mentioned, it's used on your cell phone, Siri, Alexa, self-driving cars, like Tesla's autopilot, and in the instant credit systems that is revolutionizing both the banking and the lending sector. In fact, it's hard to imagine parts of your day-to-day life that are not influenced by AI and machine learning. And while these technologies have already changed the landscape across many industries when it comes to applications in our world, investments and fund management in its adaptation of artificial intelligence and machine learning has been quite slow. But we at M&G are trying to harvest the power of artificial intelligence in the way that we manage client assets.
So Zyron, tell me, specifically, how does AI and algorithms and machine learning and all these things fit into the investment space today?
Well, Chris, people have always sought to invest in innovative companies and trends, yet that isn't necessarily a good formula for success when it comes to generating returns. The tech bubble serves as a good reminder of this. It created conditions and hype that enabled the internet to flourish, and a whole new set of businesses that have been built on top of the internet. Yet you'd have lost all your money betting on some of those early dot-com companies. The point is that we believe that when there's a true technological revolution, the best way to benefit from it is to develop the capabilities to use the said technology in your products directly. That's what we've done when it comes to AI. We're leveraging many of the same algorithms that are solving complex problems such as drug discovery, image recognition, but employ them to build models that solve our unique task. That is to predict investment returns. We're using AI techniques to glean through vast amount of financial data and help identify which stocks are most likely to outperform the market. So if you think about the investment process, ours is no different to that of traditional fund managers. We start with data that is relevant to assessing the investment process, the investment prospects of a company, and then we develop models to help predict the likely performance based on the said data. The predictions coming through these models are then used to guide to assist the fund manager to construct a portfolio of his best ideas. What's different is that rather than relying on a team of individuals for the steps of modeling and stock picking, we're harnessing machine learning to do the heavy lifting for us.
All right, so practically, how does this work in the sort of day-to-day management of portfolios?
So, Chris, if you don't mind, I'd like to show you by way of a slide how we use AI to help us generate stock picks.
Sure.
Okay. Now, of course, the secret sauce when it comes to these AI models, these models are developed using sort of our proprietary database that contains vast amounts of financial data. So it's the valuation data, technical data, fundamental data, basically anything that a human analyst would want to look at when they are assessing the prospects of a company. So our database spans over 25 years of weekly historical data and covers over 10,000 companies. So in total, that's over 10 billion data points in our database. The vast database is used to train our models to understand the relationships between financial data and share price performance. The AI models used to evaluate the prospects of every company in our investable universe. So the output is what we call an alpha score. So the alpha score is what you see on the right-hand side there. So the alpha score will go from minus 100, which means the machine learning model is saying these stocks are going to underperform, to plus 100, which the machine model is then telling us the stock is very likely to outperform the index. And so the key point here is that these models are extremely sophisticated, but they're also constantly evolving. We're always trying to incorporate newer data into these modeling techniques to stay ahead of what's happening. A good analogy, maybe if I could bring it back to things people are familiar with. If you look at your iPhone, your Apple iOS or Windows is always updating year by year to get better. So we're seeking to do the same when it comes to machine learning. We are trying to incorporate more data sets and newer modeling techniques all the time. And Chris, if I could show you an example of a stock, which will maybe bring the point home a bit more. So here we have a stock that was recommended by the machine learning model in April of last year. The blue line is the share price, and the shaded area represents the machine learning model's alpha score for that company. The company in this case is Evergreen Shipping. You might remember the story of the large bulk carrier that jammed the Suez Canal, causing major supply disruptions.
Yes.
The name of that ship was Ever Given, and the shipping company that owned and operated Ever Given was Evergreen. And so while the market was fixated on the impact of the delays and the potential fines that with regards to the Ever Given ship, it ignored the massive impact that the rising day rates was having on the company's bottom line. But the model picked up on this, and we were able to double our investment in a matter of a few months.
So Zyron, I mean, this is where it got it right. Have you got examples of actually where it got it wrong, maybe?
Yeah, I can actually show you 2 examples of where it got it wrong, Chris. So here's an example, Chris, of where the machine learning, the AI can get it wrong. Here's a company that started to flag as very attractive during the summer of last year. It's a Chinese educational services company that popped up on our list after shares had halved. Now, this is not an area of expertise for our fund managers, but through conversations with analysts in our Asia team, it became evident that there was impending regulation that had the potential to disrupt the business model of companies involved in the Chinese private education industry. Furthermore, because of the unquantifiable nature of the impact, analysts covering the stock did not update their recommendations on the stock. So we went down the checklist of things that we might look for while overriding model recommendations, and the binary nature of this impact, along with stale analyst estimates, were clear red flags. So with the help of colleagues, the fund managers were able to avoid investing in this company, which has since halved. Another example would be Russia, and this comes from a few months ago, where the world waited with bated breath in early February on what Putin's next move might be. Russian equities already started to price in the risk of war. As a consequence, you can see a large number of Russian equities started looking attractive to the model. Now, when we think about blind spots for the model, war and sanctions are things that it wouldn't have learned from its history when it was trained, and certainly not anything on the scale that we've subsequently witnessed, where we as a firm had to write down all our Russian assets to naught overnight. So we did step in here as well and made the decision to limit the active exposure to Russia to just one stock. We bought the Moscow exchange in the middle of February and subsequently written down the entire investment to zero. While we're never happy about losing money for our clients, careful human oversight ensured that losses were limited, and Russia barely shows up now on a monthly attribution, and indeed the model still managed to outperform during the month of February.
So Zyron, if I understand you correctly, I mean, it does seem to have blind spots that need a bit of a hand on the throttle. Things are unpredictable sometimes, and it doesn't necessarily pick those up. Does that mean to say an AI portfolio, can run on its own, or will it always need some sort of human intervention?
Well, Chris, we believe that the best approach is combining both human intelligence and artificial intelligence. And the reason for this is, as we demonstrated, while the model can get many things right, there are certain things that can't be modeled. Things like government, changes to government regulation, like we just showed, and wars as well. These are things that no matter how well we try to train the model, it just won't be able to predict things of that nature. And so we always believe that there's always place for humans in the process, especially when it comes to unknowables or the unknown unknowns, as they're referred to. And this brings us to the portfolio construction element of the strategy. A key feature of the construction is that we have between 90 and 100 stocks in the portfolio. Each square in the matrix on the left-hand side represents a holding in the fund, and the size of the square roughly represents the weight. So you can see this portfolio is roughly equally weighted. So the main feature is that we do not take any big macro bets in the fund, and we do not believe that those are things that can be learned by the model. So we control for the risks very prudently, even though this is a machine learning strategy.
All right. So Zyron, I mean, looking at performance, I mean, how much, if you can show us a bit on you know, how this is performed against benchmark, and perhaps, you know, being then attributable to, I would imagine, the advantage gained by adding the AI component to the general mix of things.
Sure. Thanks, Chris. So let me show you by way of a slide again. What we're looking at here is the performance attributable to the machine learning strategy within the MNG Global Equity Fund. So back from February 2018, we started running this fund 100% on machine learning. So the performance in front of you is all attributable to the machine learning. And as you say, the test is always out there in the real world, right? Simulated performances, you can't bank that, but this is what has actually materialized from the machine learning strategy. And we're very happy with this track record, actually. Since we started running it on live money, it's delivered 38.7% per annum, outperforming global equities over this period. What's particularly pleasing is that these returns have come even when more traditional quant funds have struggled, and moreover, we've weathered what was by definition an unlearnable event during the pandemic-related market sell-off and came out ahead.
Thanks, Zyron. That's quite interesting and obviously evident by you know what you said in terms of the addition of that component. Now going forward, do you see how do you guys see the future? Will this become the sort of stock standard way of operating, you know, in an investment management space using these additional tools, if I may call them that, of AI and machine learning and big data to supplement what you do in your entire portfolio range? What do you guys see for the future?
Chris, I think you're correct. I think the future is a future comprised of both man and machine. So we do think that the future is leveraging the advantages of what machines can offer you, but we do think that the human needs to stay involved in all aspects of the investment process as well. So we do think that more and more investment managers will start adopting machine learning and artificial intelligence in their processes. And we are very happy that we were early adopters of this and have gained some valuable experience, and we're able to train our machines during events, 1 in 100-year events like the pandemic.
So Zyron, yeah, kind of maybe the analogy of you know, you have these self-driven cars. I wouldn't be comfortable, I think, getting up and going, sitting in the back and let it do all its weird and wonderful things. I think it's important to always have a human in the driving seat, and this kind of seems to be very, very similar to that.
100%, Chris. I think you've nailed it there with that comment. I think a human always needs to be able to apply the brakes when needed and to just ask, is this sensible? Is what the machine is asking me to do, is what the machine is wanting to do sensible? And is it to the benefit of the humans which the machine was designed to serve?
Yeah, fair enough. I mean, you mentioned to me in the run-up about your London trip just recently, or just for the audience, what was that all about?
Yeah, I mean, I guess, well, as I mentioned, you know, in London, with all these electric cars and electric buses all around, you can barely hear them coming. So, you know, there is a perfect example of why it's important to have a human in charge of that vehicle or in charge of the bus, so that they can stop when a pedestrian is maybe looking down at their phone and not paying attention. And that's when you need the human involved, and that's where the humans are involved as well in our process.
Absolutely right. Zyron, thank you very much. It's been very interesting having you on the show, and I'd really like to chat to you guys more about this going forward. Thanks for your time. Much appreciated.
Chris, thank you so much for the opportunity, and thank you for having us at your excellent event, and we welcome the opportunity to chat with you again whenever you have time. Thank you, Chris.
My pleasure.